Have you ever wondered why Mark Zuckerberg took a loan to buy houses when he could buy 10 such houses in cash? He was the fourth richest person in the world when he bought a house, and there was no reason for him to take money from the bank to buy it. But he did. If you are wondering why, let me tell you, it is because of free money. Free money. I know there are millions of questions in your head, and the answer is not simple and straight. So let's get to them one by one. Everything is because of interest rates. Before jumping into how you can make money with debt, let's come back to Mark Zuckerberg's case and why he took out a mortgage. Mark Zuckerberg's mortgage rate is a little over 1.5%, but sometimes the rate could go up for one reason or another. Let's assume the inflation rate in the US is 2.5 to 3%. Any money an individual borrows below the inflation rate is considered free money. So, if you do the math, the bank is the loser here because the mortgage rate is way below the inflation rate. Don't be stressed because we asked you to do the math. Math isn't the complicated part here. To understand it better, consider a situation where you borrow $1 million at 1%. The average rate of return on the savings account is 2.4%. To put this in simple terms, even if you deposit that $1 million you borrowed in another bank, you end up making $24,000 a year, while your monthly payment to the bank from which you borrowed money would be just $10,500. Why billionaires borrow money? Now imagine using the same strategy for billions and billions of dollars. This is the reason why billionaires borrow money. There is no reason to invest your own money when you can borrow free money. We understand that this may not make sense to you if you are speaking about a small amount of money because the difference isn't big. But when it comes to millions and billions, 1% or 1.5% interest can be a huge deal. Let's say you're a young businessman, and instead of investing your money to buy a house, why not invest it in your business and get a mortgage to buy the house? Even if you aren't interested in making more profit using that money, throwing all that money in an index fund is more helpful than buying a house, especially if it's for the long term, like 20 to 30 years. That's because an index fund has shown to have an average return of 8%. So if you take a mortgage and invest your money in an index fund, no force in the world can stop you from taking the percentage difference. Billionaires' strategy. This strategy is commonly used by billionaires. For example, Elon Musk, founder of Tesla and SpaceX, bought a house for $20 million. He had two options in front of him: sell a portion of his assets and pay for the house, tax, and other expenses, or take free money and keep his monthly payment under his budget. Him, being the intelligent businessman, chose the second option. He took a $61 million mortgage for 5 properties in California with a monthly payment of $180,000. The same strategy is also used by Hollywood celebs like Jay-Z and Beyoncé. The couple put in a 40% down payment and financed the other $52.8 million. The couple pays $149,600 monthly. The national median home value is $200,700. So instead of tidying $53 million for a house, Jay-Z made a wise choice. Jay-Z is known for making great financial investments. He has made many such great financial decisions, and he is on his way to becoming a billionaire. It is no secret that the richer you get, the easier and better it gets to make money. But one thing to remember is not everyone gets such a low mortgage rate. The nationwide mortgage rate is around 3%, but it is still not the reason to purchase a house if you can finance it. But here is something you should know: rich people get less interest than the rest of the country. Why and how do rich people get less interest rates than others? First, it is easier to get a loan when you are a billionaire compared to an average worker because the bank knows you won't default on your loan. If something happens to you, you can easily sell your business or even a part of your business and pay your mortgage back. So, the risk is out of the equation. But if you are an average worker working on minimum wage, it is unlikely to get a loan unless you have some huge assets, because you can get sick or lose your job. It is extremely difficult to pay the loan if you lose your job. Therefore, the risk is a major factor in the equation. The second reason is that consistently paying your mortgage on time helps your relationship with the bank. When we say your relationship with the bank, we mean your credit scores. Why do you need a credit score, you ask? So, when you are in financial trouble next time, banks will analyze your credit score. This way, it will be much easier to borrow money. The bottom line here is to build trust between you and the bank. And the other side of this coin is banks offer low mortgages to rich people to establish a strong relationship with them. There it is. Why rich people get lower interest rates than the rest of the country. Banks pester billionaires to steal them from their competitors. If you see it, it's a win-win situation. Billionaires get low-rate interest, and banks get to build trust. But it is notable that these mortgage rates could go up. As surprising as it sounds, it is true that there is a chance that mortgage rates could increase because, once the entire concept stops making sense to rich people, they can pay back their mortgage easily. Why do we think debt is bad? Unlike rich people, we have a bad impression regarding debt. But why? In the case of people who aren't wealthy, they get into debt because they usually borrow money for entertainment they can't afford. This is why most of us end up paying a lot more back. In today's economy, as soon as young adults graduate from college, they graduate with a huge debt. I hope you don't need a detailed explanation of America's student debt crisis. Once the person realizes that they are paying back more than they borrowed, a voice in their head goes, "Debt is bad," and this voice becomes your opinion, and slowly, this opinion will be your major mindset. Well, the voice in your head is not entirely false. Debt can be bad, especially when you can't default on it, and even paying it isn't easy. One small miscalculation and a small risk can cost you a fortune. But, you see, paying a fortune is difficult when you don't have the fortune to begin with. People who live paycheck to paycheck can't handle an extra $500 bill. Good debt and bad debt. We aren't saying that there is no way debt can make you go broke, ruin your family, or make you homeless. It can. But it can also make you unbelievably rich if you know how to use it as leverage. If you are wondering what leverage is, Aladdin's lamp can grant your wish to be rich. Let's see how you can use this strategy for your benefit. If you buy a phone for $10,000, sell it for $11,000. Congrats on the $1,000 profit. Now open champagne to celebrate. But wait, this isn't it. Use Aladdin's lamp, leverage here. Go to the bank first and borrow $990,000. Adding your $10,000, you are now a millionaire. Champagne, please, but wait. Now buy 100 phones for $1 million and sell them for $1.1 million. But, you owe $990,000 to the bank, so return their money and $10,000 as interest. Now you have $100,000. If you deduct your $10,000, you have $90,000 pure profit. And now, my friend, this is how to make money when you have no money. Now open a champagne to celebrate. But, if it's not regulated by the government and practiced by everyone on Wall Street, it'll pave the way to the 2008 financial crisis. The main reason for the crash is the investment banks took leverage on houses, which backfired. This happens when you give mortgages to people who don't have good credit scores. Banks learned their lesson the hard way. Let us know your thoughts in the comments, and we hope this video has helped you.